I don't know. I'm not gonna lie, I'm extremely close to you. Like, wow, that humbled me. Yes. Oh, right? I'm like, probably.
I don't think it's going to be finished. Like, say that everyone, not the performance.
Oh, okay.
Something you really need some time. Something you need. We don't know the example.
All right, it's 1 o'clock. Let's go ahead and get started. All right, good afternoon, everyone. How's everyone doing today? Good. I'm good. Thanks for asking. All right, so I graded your midterm ones, and so probably a lot of you found out last night, and so your grade should be posted on Canvas. I brought your exams here today, so I'll go ahead and give those out after the class. So the average is really good. You guys did really well on the exam, so I'm really happy with that. So the average was about 42 out of 50. And so it's about 84%, which is, fantastic. So well done. Good job, guys. Other announcements I have to make. First of all, with the midterm, please, if you're here today, please pick it up and please look over your exam. And so I don't try to, but I make mistakes, when I grade sometimes. And so if I add up points wrong, or if you think you deserve more points, or if you want to discuss some of the feedback that I gave you on the exam, I try to keep it a little bit light just because I was a little bit busy this week, and I wanted to make sure I get these back. I got these back to you within a week. And so if you're confused about why I marked something down and you want to ask questions on that, I'm always happy to talk about that. So please take a look at your exam, and then just if you have any questions or if I added up anything wrong, just let me know. Okay. Other announcement I want to make is homework 4 is posted, and so homework 4 I just posted this morning. And so that's going to be due in about 2 weeks, and so it's going to be due on October 20th. Okay, so I'm giving you a bit longer than normal on this homework assignment because it is a bit time consuming. And so the subject for this homework is going to be rate of return analysis. If you remember, that's kind of what we did right before the midterm, and then all the tax stuff. And so the tax problems especially can be pretty time consuming. And so definitely don't wait till the last minute to do this homework because it's it can take a while. Okay. All right, and so that's all my announcements. Are there any questions I can answer before we get started? Okay, all right, so let's go ahead and pick up where we left off. And so I believe on Tuesday we left off right in the middle of an example. So let's go ahead and just finish that up. So I'm just going to scroll up here a bit. Okay. And so I'm not going to write down the whole problem again, but basically here's the gist of it. And so this is kind of our first time doing what I consider like an after-tax cash flow calculation. Okay. And so our situation here is that we have a company that purchased a truck for $50,000, and they want to know how much money they're going to make off the truck after taxes. Okay. And so the first thing that we did was we, just for comparison's sake, was we analyzed this problem as if it were, a before tax calculation. So we set up our cash flow conversions basically this exact same way we did before. And so we found that the after tax, or excuse me, the before tax present worth for the truck was about $32,000. Okay. And then where we left off on Tuesday was we were, doing the same calculation, but considering taxes. Okay. And so the main thing that you have to consider when doing tax calculations is the depreciation. Okay. And so we know that this truck is a fairly large asset. And so it's going to last the company, in this case, it's going to last them at least 5 years. And so each year that they use this truck, that truck is going to lose value. And then however much value the truck loses per year, we can deduct that from our taxes. And so remember, that was called our depreciation. Okay. And so for this problem, we're using the simplest depreciation method, which is a straight line. And so what we said is that the truck is going to lose about $8,000 of value each year. And so that means each year we can deduct $8,000 of from our taxable income. Okay. And so we started the solution here. And so whenever you're doing a tax calculation, you're going to make a table like this, okay? And you're going to basically compute it row by row. Right? And so we started with row 0, and so that is the initial value. And so we know that we had this truck had an initial cost of $50,000. And so what we say is that we have a minus 50,000 in year 0. Okay, and then all the other columns are blank. And then we started working on the taxable years. And so in year 1, we know that this truck is going to generate $20,000 of revenue each year. So our before tax cash flow is $20,000. We know that the truck is going to lose value in the amount of $8,000 that year. And so our depreciation for that year is $8,000. And so if we subtract those two, and so we take our income for that year, we minus our depreciation, that's how we get our taxable income. And so for that year, $12,000 out of the $20,000 that they made, that's going to be taxed. Okay. And then to compute the taxes, all we did was we took the taxable income, We multiplied it by the tax rate, and the tax rate for this problem was 21%. And so 21% of the $12,000 is 2,520. And then to get the after-tax cash flow, all we did was we took our before-tax cash flow, which was 20,000, and we subtract the taxes, and that's how we got 17,480. Okay. All right, so I'm going to go ahead and repeat that same logic. And so the nice thing about straight line depreciation is that every year is more or less the same. Okay. And so in year 2, our before tax cash flow is going to be 20,000. We're going to depreciate $8,000. That's how much value we lost off the truck. Okay, taxable income 12,000. We take 21% of that. We get 2,520. And so our after-tax cash flow is 17,480. Okay. And so I'm just going to repeat this, over the next few years. Okay. All right, and so years 2, 3, and 4 are going to be basically identical to year 1. Okay. The exception to this is going to be year 5, which is the last year of operation for this truck, because not only do we have the $20,000 that we made off the revenue for the truck, but we also have an additional 10,000, because what we said in the problem was that after we're done using this truck, we can salvage it for $10,000. Okay, and so our before tax cash flow that year is going to be 20,000. Which is the normal amount, plus the 10,000 that we got from salvage. Okay. And so for that last year, we have a before tax cash flow of $30,000. Okay. Okay. Our depreciation is the same though. And so the only value that we lost from the truck was $8,000. Okay. But now this is going to make a difference for our taxable income. And so our taxable income for that year is going to be $22,000. Okay. So we're going to get taxed on a lot more because we have that additional salvage value. And so if we take 21% of 22,000, we get 4,620. And so our after-tax cash flow for that year is 2,500 or 25,380. Okay. Okay. So now that we've completed the table, we can compute the after-tax present worth. Okay. And so the after-tax present worth is going to be just all the cash flows in the last column, and also the initial cost. Okay. And so what we can see here, we have a recurring cash flow of 17,480, and that's going to take place for 4 years. Okay. So that can be a uniform series, and then we have one future sum of 25,380 at the end. Okay. So is everyone done writing down everything in this table? Okay. Okay. So let's go ahead and compute that. All right. So the after-tax present worth. First thing we have is the minus 50,000. That was our initial cost. Then on top of that, we have 17,480, which is a uniform series. So this is a recurring benefit that occurs in years 1 through 4. Okay. And so we need a P over A. Our interest rate for this problem was 10%. And then we'll say it takes place over 4 years. Okay. And then finally, we have the bigger sum in year 5. And so this is just a single future sum. And so this is P over F, 10%. And it occurs in year 5. Okay. Okay, and so we look up those two conversion values in the compound interest table, and what we get is an after-tax present worth of 21,171.79. Okay. And so if you compare that to our before tax calculation, and so, if we were to do this problem, as if we, before this week without any taxes, our before tax present worth was 32,000. And so after we factor taxes in, our after tax present worth here is more than $10,000 less than it was before. Okay. So you can see taxes make a big difference. And so, it's really important to account for this, whenever you're doing these calculations. Okay? Okay. All right. Any questions on that example there? Okay. All right. And so that's kind of your first kind of our first taste of what a tax calculation looks like. Okay. And so the question is, we use a truck in that example as something that is a typical depreciable asset. But let's kind of talk more generally about that. So let's talk about, what kinds of equipment or what kinds of assets are applicable for depreciation. Okay. Okay. All right, and so there's three kind of main characteristics or three conditions that must be met in order for you to use depreciation on an asset. Okay. Number one, the asset must be used for business purposes to produce income. Okay. And so assets that you buy for or equipment that you buy for personal use, it doesn't count for this because it's not part of your business. Okay? So it has to be a business expense. Okay. Okay. Number two is that it must have a useful life that can be determined. Okay. And so you have to be able to put a number on how long this asset is going to last. Okay. And this has to be greater than 1 year. Okay. And then number three. And so condition three says that the asset must be, the asset must be something that either gets used up or maybe decays or maybe wears out over time. And so there has to be some kind of physical basis or physical, way that you can see that the asset is losing value over time. All right, and so if your asset meets these three conditions, then it's applicable for depreciation. Okay. All right, and so these are important because you know, for tax purposes, it would be great if a business can expense all of their, you know, all their costs away, you know, from their taxable income. Okay? And so I'll leave you with the question. I'll give you guys a question right now, and you know, and you can answer it on the homework. It's one of the short answer questions on the homework. And so, considering these three conditions for whether an asset should be that needs to satisfy in order to be depreciable, think about land. And so, another thing that that companies purchase a lot in order to run their business, especially businesses like agriculture, things like that. They have to purchase land in order to grow crops or, you know, have a business and stuff like that. And so, considering these three conditions, you know, I want you to think about if land counts as a depreciable asset. Okay, and if a company is able to take the cost of that land and then you know, depreciate that away from their taxes. Okay, and so think about it, and then, you know, put your answer in homework form. Okay. Okay. All right. So now let's talk a bit about you know, what happens when you sell an asset. Okay? And so how does that interact with depreciation? Okay. And so on Tuesday, you know, we mentioned this this definition called the book value, right? And so the book value, remember, we defined that as the current value of the asset for tax purposes. Okay? Okay. And so if we consider the truck from the example that we started with today, you know, we know the truck loses about $8,000 of value each year. And so after a year, you know, after a year, the truck is said to have $42,000 of value. That 42,000, that's the book value of the truck. Okay. But the book value, you know, may not be the same as the amount of money that you can actually get for selling it. Okay. And so in addition to book value, we also have market value. Okay. And so market value is the amount of money that you can get for selling the asset at any given time. Okay. And so you would think that these two definitions here are the same, right? And so, you know, if we're using our definition of depreciation in terms of how much value with the assets losing over time, then that should be, the book value should be the same as the market value. So what's on the books in terms of, you know, how much the asset is worth should be the same as what you can sell it for, right? Because that's what makes sense. But in reality, you know, these two often are not, they're not exactly the same. So there's often going to be a difference between, you know, if you sell an asset, what you actually get for it versus how much it's worth in the books. Okay. And then depending on, you know, the difference in these two values, you may get taxed on the difference. Okay. And so there's three kind of situations depending on the relative values of these two. Okay. Okay. Number one. So number one is a case when the market value is greater than the book value. And that's called depreciation recapture. Okay. Another name for this is ordinary gains. Okay, so this was what happens when assets is sold for more okay. And so when an asset is sold for more than its book value, you get taxed on the difference between the two. Okay. And so visually, we can go ahead and plot it out. Okay. And so let's say that this bar right here, this is the market value. Okay. And so, if the y-axis here is money, and so if you sell an asset for that much, but in the books, it may only be worth this much. Okay. Then on the difference, how much more you sold it over the book value, you get taxed on this. Okay. And this difference right here, this is called ordinary gains. Okay, so that's the first case, and so that's the first. So if market value is greater than book value, you get taxed on it. Okay, which makes sense because that's considered profit basically. Okay. Number two is called loss, and so when you sell an asset at a loss, that means the market value is less than the book value. Okay. And so in that situation, you don't get taxed on the difference, right? Because the asset was worth more in the books compared to what you sold it for, and so you don't have to pay taxes on it. Okay, so I'm not going to draw that because it's just the same curve, but same graph, but the book value is higher. Okay. All right, and number three, the third case is called capital gains. Okay. And so capital gains happen when the market value is higher than the book value, but it's also higher than the original price that you paid it for. Okay. And so this is significant because, just like ordinary gains, you're going to get taxed on anything that's above the book value. But for any excess that you have over the original price, then you might get taxed differently at a different rate. Okay. Okay. And so it might look something like this. Okay, so once again, our y-axis here is money. Okay. And so this first column here, we'll say this is the market value. So that's how much you sold it for. Okay. We'll say the book value is this. And then this last column right here, this will represent the original price. Okay. So let's go ahead and label this. And so all the way up until the original price, this right here is ordinary gains. Okay. And so you're gonna get taxed on that, to a certain degree. But anything above this, in this case, you sold it for higher than the original price. Then this right here, this would be capital gains. Okay. And so that might be taxed differently than the original. Okay. All right, any questions on this? Okay. All right, and so that's that's just a bit of information of what happens when you sell. Okay. And this can happen, quite a lot. I think you probably hear about this a lot talked about in terms of stocks. But the similar rules apply when you're selling business related assets. Okay. Okay. So let's jump back to depreciation. Okay. So we've covered, we've done one example showing the full kind of tax calculations with a straight line depreciation. But I think I mentioned on Tuesday that there are 4 total depreciation methods. Okay, so let's go over, the other 3. Okay. And so the first one that I'll go over is called declining balance depreciation. And so this is going to be a different way that we can model, or a different way that we can compute how much value the asset is going to lose each time period. Okay. All right, because all we've done so far is just straight line. And so for straight line depreciation, we made the assumption that the asset is going to lose a fixed amount of value each year. Okay. Declining balance is just a different kind of way to look at that. And so under declining balance depreciation, what we say is that the asset is going to lose a certain percentage of its book value each time period. Okay. And so the formula for this, we'll call it DT. And so all you're going to take is just 2 divided by n multiplied by the previous book value. Okay. And of course, big N here, this is the number of time periods for your analysis. Okay. Okay, so for declining balance, it's a little bit more complex than straight line depreciation, because you not only have to keep track of, you know, all the revenue, costs, and all everything like that, but you also have to track what the book value is over time, okay? Because you need to take a percentage of that book value, and that's going to be your next, you know, your next depreciation. Okay. All right. And so one important note about declining balance is that there is kind of an implicit assumption that you're going to have a salvage value of 0. Okay. All right, so I'm gonna do an example here. I'm not gonna run through the full tax calculation just because that's, you know, pretty time consuming, and I want to make sure I get through enough today. But I will show you how to compute, you know, the depreciation amounts each year. Okay. So before I do that example, are there any questions on just the concept of declining balance here? Okay. Okay, so let's do an example. Okay, it's a new example, but it's the same asset. And so we're going to assume that we are purchasing a truck for $50,000. Okay. And that we plan to use this truck for 5 years. And so what we want to do is we want to use declining balance to compute its depreciation schedule. Okay. And so notice that, you know, we're not going to do the full tax calculation here. We just want to find out in each time period how much value is the asset going to use. Okay. And so when I ask for a depreciation schedule, that's all I want. And so I just want to know, you know, in each time period how much value we're losing. Okay. Okay. So let me do this. And so let me make 3 columns here. And so I have 1 column for the year. Of a second column for the depreciation amount. And then we'll have a third column for the book value. Okay. And do 1, 2, 3, 4, 5. All right, and so under declining balance, we know that we're going to use the formula up here. Okay. And so if we plug in for that formula, we say dt is equal to 2 divided by n. N in this case is 5 because we have we're going to plan to use this truck for 5 years. Okay. And then we're going to multiply that by the previous book value. Okay, and so it's going to be just 40% or 0.4 of whatever the previous book value was. Okay. Okay. So let's go ahead and plug in and you know, and compute this. Okay. And so in year one, you know, our previous book value was just our purchase price, right? And so at the end of year one, you know, the last time we assessed the value of our asset was when we purchased it. And so, you know, the previous book value in this case is going to be 50,000. Okay. It's going to be 0.4 times the purchase price, which is 50,000. Okay. And so we compute that, we do 0.4 times 50,000 to get 20,000. Okay. And so the depreciation charge in year one is 20,000. And so under declining balance, we say that the truck has lost $20,000 of value in that first year. Okay. And so our book value is just going to be whatever's left, right? And so if we started with 50,000, we lost $20,000 of value. That means our book value at the end of year one is going to be 30,000. Okay. Okay. So now we can just continue on. And so in year two, our depreciation for that year is going to be 0.4 multiplied by the previous book value. And so if we're in year two, the previous book value was the book value up to year one. Okay, so it's going to be 0.4 times 30,000. And so we compute this. This is equal to 12,000. Oops. Just 12,000. Okay. And so once again, we're going to subtract that. And so we do 30,000 minus 12,000. And so after we depreciate that 12,000, we're left with 18,000 of the book value. Okay. And then I'm just going to continue this trend. And so D3 here is going to be 0.4 times the previous book value, which is 18,000. Okay. We compute that, that's equal to 7,200. Okay. And so we do 18,000 minus 7,200, we get 10,800. Okay. Okay, so year four, we're going to take 0.4 of that. So 0.4 times 10,800. We get that, we get 4320. Okay. And so we subtract those two things, we get 6,480. Okay. And then finally in year five, we have D5 is equal to 0.4 times whatever's left, 6,480. And what we get from that is 2,592. Okay. And so we perform that subtraction, and we're left with the book value of 3,888. Okay, and so if you're doing declining balance, you have to kind of keep track of the book value. You know, otherwise there's just no way that you can do this. Okay, so it's a little bit extra. It's a little bit extra calculation, but it's it's not too bad. The factor, the rate or the percentage that you're going to take is the same every year. It's just that the book value is going to be different. Okay. All right. Any questions on this? Okay. All right. So that's declining balance, and so that's kind of the next step up in terms of complications for depreciation. The next one that I'm going to go over is called bonus depreciation. So is everyone good writing stuff down? Can I scroll up? Okay. All right, so bonus depreciation is relatively new, and so straight line depreciation and declining balance are kind of the mainstays. But bonus depreciation, because it happened because it was made to kind of help things be simpler. Okay? And so with bonus depreciation, this is kind of a special one because it only occurs in after the first year. Okay. And so what bonus depreciation says is that at the end of that first year, you can take just a flat percentage of the original cost off of the, as depreciation. Okay. And so the way bonus depreciation is defined is that you define a percentage, and then you take that percentage of the original cost, and then that's how much you depreciate that year. Right? And you can even bring this up to 100%. And so, I know, and that's why I say this is relatively new, because I know last time we spent a long time talking about depreciation is, an asset loses value slowly over time. Okay. But with bonus depreciation, we kind of just ignore that. And so with bonus depreciation, we just kind of deduct the entire cost of an asset right up front. And so to do that, you basically set the bonus percentage equal to 100%. Okay. So, it kind of breaks all the rules of depreciation. And so under bonus depreciation, you basically say that, I bought this asset, here's the cost, and I'm going to deduct that entire cost away from the taxable income. Okay. And the reason companies would want to do this, I think I'll go ahead and save that for the example. Okay. So this is the next example. I'm going to go and redo the whole, the whole tax calculation, just so you can see why companies would want to do this relative to, either straight line or declining balance. All right. So just so we can have an apples to apples comparison, let's look at the exact same example that we did before. And so we have a truck. The truck costs $50,000. And it makes $20,000 a year in revenue. Okay. The number of years, or the lifetime of the truck, is going to be 5 years. And our interest rate is going to be 10%. Okay. And so if we use 100% bonus depreciation, okay, and if we assume a tax rate of 21%, okay, let's compute the after-tax present worth. Okay. So I'm going to go ahead and make the table again. This will be the full table, and so we're going to have the all the same columns as our first example today. Okay. Yeah, half the time that you spend doing tax problems is just writing out this whole table. So I get asked this question, you know, especially as people start working on homework 4. I get asked if it's possible to do this in some kind of spreadsheet. So if you want to do this in Google Sheets or Excel, I'd say be my guest. And so, definitely make use of technology to kind of save on some of the tedium. So I think with the tax calculations, it's not particularly complicated. It's just a little bit tedious. And so if you want to use Excel to kind of speed things up, I would say go for it. Just be aware that on the exam, if I ask you a tax question that I'm going to expect you to write this table out anyway. So if you want to get practice writing it out, then maybe do maybe 1 or 2 of them with paper. But then for the more complicated ones, you can use Excel, and that's totally fine with me. Okay. Okay, so let's write 5 rows. Or 6 rows, excuse me. First one's row 0. And just like we did with the straight line depreciation on year 0, we're going to have our initial cost there, which is 50,000. Okay. And everything else is blank. And then every year after that, we're going to write out our revenue for that year. Okay, so we know the truck makes $20,000 a year. And then in year 5, remember, we also have the salvage value. And so we're going to have a cash flow of 20,000 plus 10,000, which is 30,000 in year 5. Okay. Okay. All right, and so kind of the main difference in this problem is that we're using 100% bonus depreciation. And so that means in year 1, we're just going to depreciate the entire cost of the truck. And so our depreciation for year 1 is going to be $50,000. Okay. And so that means remember, our taxable income is our revenue minus our depreciation. We actually get a negative number. Okay. And so we take 20,000 minus 50,000. And we get minus 30,000. Okay. And so you may be asking, what does it mean to have a negative taxable income? Well, that means that you get to pay negative taxes, and negative taxes is a tax credit. And so that's, a lot of companies actually just use that to pay for taxes in the future, but you can just consider it as like a positive cash flow. Okay, so your taxes that year is going to be 21% of 30,000, and so it's going to be minus 6,300. And so if we add that to our before tax cash flow, and so we had a revenue of 20,000 that year, we have a tax credit of 6,300, and so we add those together, we get 26,300. All right, so let's go ahead and fill in the rest of the table, because the rest of the table is going to be more or less the same. And so, we get that really nice tax credit in year 1, but that means for years 2 through 5, we're going to pay taxes on the full, on basically every cent that we make on those years. Okay. And so in years 2, 3, and 4, we have a taxable income of 20,000. Okay. We're going to pay taxes on all of that. And so we take 21% of 20,000. Get 4,200. 4,200 each of those years. Okay. And so if we subtract that from the revenue of that year, we get 15,800. Okay. And then for the last year, we made $30,000 if you count the salvage value. And so we take the taxes of that, we take 21%, we get 6,300. But instead of being a tax credit, this is a tax drain. I guess we pay those taxes out. And so we take 30,000 minus 6,300, and that's 23,700. Okay. Okay. So now that we've done all the tax calculations, the next step is to compute the after-tax present worth. Okay. And just like we did before, we're going to use the last column as well as the initial cost there, okay? And just as a comparison, and so let me go ahead and write this in down here. And so with straight line depreciation, just to remind you, with straight line depreciation, we got an after-tax present worth. What was the, I guess I can look up the exact number. What was the exact number? Exact number was 21,171.79. Okay. All right. So of course, I'm putting that there so that we can compare with bonus depreciation. Okay. And so, it's good to think about, if you have bonus depreciation, is that going to end up with a better present worth than straight line, or is it going to end up with a worse? Okay. And so, the nice thing about bonus is that, you get a really nice bonus at the beginning, but then each year after that, you have to pay full tax. So, it's good to think about what that actually means or how that's going to translate to the present worth. Okay, so let's go ahead and run through the calculations. And so we have minus 50,000. That's our initial cost. Then we have, let's see. So the way I'm going to do this is I'm going to say we have a uniform series of 15,800 for 4 years. Okay. That includes year 1, but of course in year 1 we made more money than that. And so in year 1, we're going to have a future sum, and the future sum for this is going to be the difference. So it's going to be 26,300 minus 15,800. Okay, because we've already accounted for the 15,800 in year 1 with a uniform series, and so we just have to add the excess. Okay, so it's going to be P over F, 10%, and 1. Okay, so this is the excess in year 1. Okay. And then to this, we're going to add the future sum in year 5. So 23,700 times P over F, 10%, and 5. Okay, so that's our after-tax present worth. And so if we run through those calculations, we plug in all of the conversion factors. What we get is an after-tax present worth of 24,348.46. Okay. Right, and so if you compare this value to what we get with straight line, you can see that we get a much higher present worth using 100% bonus depreciation versus straight line. Okay, and so you can see here that from a tax perspective, it's very advantageous to to depreciate the full cost right up front. Okay, so I call this kind of a more aggressive depreciation. Okay. Okay. And so generally speaking, the more costs that you can depreciate upfront or early on in the asset's life cycle, that's going to end up with a better present worth than you had before. Okay. And so a little bit of trivia. So when Trump was president, he actually did his tax policy was actually 100% bonus depreciation. So businesses loved it because they were able to make a lot of capital purchases, do a lot of investment in their infrastructure, and then depreciate all of that at once and get huge tax breaks on that year. So it was a very there's a lot of aggressive kind of capital spending during that time because people were trying to take advantage of this 100% bonus depreciation. Okay? But at the same time, it's a little bit risky. And so, with the 100% bonus depreciation, after year one, you're basically going to have a book value of 0. And so if you were in a situation where you're going to sell the asset early, if we come back to our selling rules here, okay, if you were to sell the asset early and your book value was nothing. Hello. Well, my stylus is not working. It's weird, right? And so if your book value was nothing, right, after year one, and you had to sell it, then you'd have to pay taxes on all of that. And so it's a bit of a risk, and so you can depreciate everything early, but then you're kind of, you kind of have to keep using that asset for its life. Otherwise, you're gonna have to pay a lot of taxes on its sale. Okay. All right. Any questions on this? Yeah.
Do you choose how your assets taxed, or is it for the president?
Yeah, usually depends on the administration. And so I'm actually, I should have looked this up, but I'm not sure what Biden's policy is right now. But yeah, it usually depends on the administration. And then, and they change it based on, how the economy is doing at the time and based on what they want businesses to do. And so if you have a policy like 100% bonus, then it's going to be, very friendly to businesses to like kind of stimulate and make a lot of investments because, it's going to give them a lot of tax breaks in the short term. Okay. All right. And so that's the third method for depreciation, and that's one that's been very trendy recently. But then we have another form for the depreciation that's in our tax code known as MACRS. Okay, and so MACRS stands for the Modified Accelerated Cost Recovery System. Okay. But no one says the full name, and so they just call it MACRS. Okay. And so from that last example, you can see that it's better for businesses to depreciate, or they generally want to depreciate most of their value up front. Okay. But they're for tax purposes, that means less money for the government at that time. So this is kind of a compromise between a lot of those systems. Okay. And so this is actually very recent. And so this was written into our tax code in the Tax Reform Act of 1986. Okay. And so this system here was kind of created as a compromise in terms of letting businesses depreciate a lot early, but not so much that they kind of put themselves in a lot of risk. Okay. And so mathematically, if you kind of look at the numbers in terms of how this works, it's kind of a hybrid between the first two methods that we went over. So it's kind of a hybrid of declining balance and straight line depreciation. Okay. but the way that you actually compute it is actually similar to bonus. Okay. And so, the way this works is that, depending on the type of property that it is, or depending on the type of asset, you're going to be given a schedule that is a percentage per year. Okay. And then to compute the depreciation charges for that year, you just take that percentage and you multiply it by, the original cost. Okay. Okay. But in order to use this system, we first have to classify what kind of asset that you have, because depending on the type of asset, then you're going to have a different depreciation schedule. All right, and so this is kind of where it gets complicated, because depending on what your asset is, it's going to be sorted into one of these three or one of these six categories. Okay. And so I'm not going to write every example here because the list is pretty long, and so I will say the full list is in the notes. And probably even better than that, you can probably find an updated and more comprehensive list if you look online. But I'm just going to give a couple examples in each class just so that you can have an idea of what what this means. Okay. And so the first class we have is a 3-year property. Okay. So these are assets that are expected to generally last in the ballpark of 3 years. It doesn't have to last exactly 3 years, but these are more of the short-term assets. Okay. And so some examples of this would be like fabricated metal products. Or food and beverage handling devices. Okay. And so again, there's the list for 3-year assets is a lot higher, but you can check the notes for the full list. Okay. All right, next we have a 5-year property, and so these are going to be most of your automobiles and trucks. Okay. Computer equipment is listed in this category as well. Okay, so those are the main things that is in the 5 years. The 5 years is pretty common, especially with a lot of the work that I do for my research. Like I work with a lot of computer equipment, and what you'll see is that a lot of commercial and government supercomputers, they replace their parts every 5 years because they're on kind of a 5-year time. Okay. All right. Next we have 7-year, and so 7 years is an interesting one, and because 7-year is kind of the all other category. So because it's kind of the one that's in the middle. And so if you have an asset that doesn't fall into one of the other categories, they just stick it in the 7-year category. Okay. But the ones that do belong in this category would be things like office furniture. Okay, particularly expensive pieces of office furniture. Fixtures, so things like lighting, things like that. And just all other assets. Okay. Every time I sit down in my office chair and I lean back and I hear it creaking like crazy, I'm like, come on, hang in there, man. You gotta last for 7 years. I don't think my office chair is gonna last for 7 years. All right, next we have a 10-year property. So these are kind of the longer term ones. And so these are equipments that are expected to last a long time. Okay. So these are things like petroleum refining. And any kind of water transfer equipment. Okay. There's also 15-year, although we won't be doing problems with 15 years. Okay, so 15-year tax calculation is be crazy, but I want to let you know that it exists. And so these are things like telephone distribution equipment. And sewage treatment. And there is a 20-year class, at least when this textbook was written, there was a 20-year class, and that's for municipal sewers. Okay. And so again, if you want to see the full list, probably online would probably be more reliable. It might be a little bit out of date because I don't know if we're still using this, currently right now, but it is written in the tax code, and so we could switch back to this at any time. Okay. All right. Any question on this? Okay. All right, and so when you're using Macros, you have to assign it a class first, okay? And then depending on the class is going to give you the depreciation schedule. Okay? And so let me kind of show you what that then looks like. I'm not going to list all of them because 20 lines of percentages is kind of a lot, but I'll show you at least the 3, the 5, and the 7-year properties. Okay. And so remember, the way that Macros works is that, depending on your asset class, you're going to depreciate a fixed percentage of the asset's cost per year. Okay. Okay, so for a 3-year property, in the first year, you're going to depreciate 33.3%. Okay. In year 2, you're going to depreciate 44.45%. Year 3 is going to be 14.81%. And year 4 is going to be 7.41%. Okay. So you're probably wondering, why, if it's a 3-year property, why are we still depreciating stuff into the 4th year? And the reason for this is that under Macros, they use what's called the half-year convention. And so that basically assumes that you don't actually put the asset into operation until halfway through the first year. Okay. And so that depreciation charge in year 1, That's only for half of the first year. Okay. And so since the asset is assumed to start halfway through year one, that means it still has about half a year's worth of depreciation in the year plus one of the whatever it's classed for. Okay, so that's why the 3-year property has a little bit in year 4. And you're going to see the same trends for the 5-year property and the 7-year property. Okay. Okay, so those are the numbers for the 5-year. So we have a 6-year scale for that. And then for the 7-year property, we have 10, 18, 14.4, 1.52, 9.22, 7.37, 6.55. Oh, I'm sorry, I'm reading the wrong column. I have the 10-year property here, but I was reading off the 10-year column. Like, that's not right. My iPad's really lagging right now. All right, so the 7-year property, we have 14.29, 24.49, 17.49, 12.49, 8.93, 8.93, 8.93, and then finally we have 4.46. Sorry about that. Right. But the full table is in the notes, and so you can definitely look at the table there. Okay, so we're just about out of time. I did want to end just a little bit early today, just because I have your exams here, and I know you guys want to pick it up. But on Tuesday, we'll pick this up again. We'll do an example where I show you kind of how to use this, and then we'll go ahead and move on to the next topic. So are there any final questions on taxes for today? Okay, all right. So if there's no more questions, you can come pick up your exams up here. So once again, the average was 42 out of 50. So you guys did really well. And if you have any questions on it, just go ahead and let me know. So I split it into 2 piles just so 2 people can look through the pile of that. So, you and Marcus. So if you're on Zoom too, I'll bring the exams on Tuesday as well. Or if you want to drop by my office on Tuesday or Thursday, then you can come pick up the exam then. Zoom people, are there any final questions before I wrap it up? Okay, all right, so I'll see you guys next Tuesday.